Today, we're talking about tax strategies, tax planning, retirement tax surprises, Roth IRA conversions, and much more with our special guest, Linda Reeder. Now, Linda is an IRS enrolled agent and the owner of TaxRez, serving individuals, families, small businesses, trusts, and partnerships. She has more than 20 years of experience helping people understand the often confusing world of taxes, comply with federal and state tax laws, and navigating the IRS complexities. In addition to working directly with clients, Linda has also served as a master instructor and district trainer with mentoring other tax professionals. I also love her personal model that she has created her own self, making sense out of the nonsense, because I think that's exactly what we all need, is to cut through the noise and get right to the point on here. Throughout our conversation today, we'll discuss topics such as the differences between tax preparation and tax planning, common Roth IRA conversion misconceptions, retirement tax surprises, state taxes like North Carolina and Arizona, legacy and inheritance planning, and so much more, to also include the common questions so many people don't ask and need to be aware of. Linda, thank you again so much here for joining me here today. Before we jump into our discussion here, Linda, I'd love people to get to know more about yourself, what you do, what you're at, what you focus on. Linda, can you kind of introduce us to who you are and what a enrolled agent is?
I absolutely would love to. So an enrolled agent is a certified tax professional with the Internal Revenue Service that we're sanctioned under what's called the Section 230 rules. Basically, all we do is tax focus. I'm allowed to represent before the Internal Revenue Service on behalf of the clients, aka the taxpayers, much like what a CPA or a tax attorney would do. My level is I can go as high as tax court, which obviously after that you have to have an attorney. And then of course, for me personally, I have done this, and I'm going to age myself a smidge. I have done this for 28 years. So I've seen a lot of ups, downs, sideways, and all of those good things. But one of the things that keeps me in the grind is I love being able to help bring this complicated thing down to a level of understanding to the average guy or gal, and just be able to make, like I said, sense out of the nonsense, because there's just so much myths, bad information out there that I think a lot of people are afraid to ask, and hopefully I make it easy for them to ask.
Well, you have tons of knowledge and wisdom in 28 years. You've heard it all, I'm sure. Tons of situations on there. Now, I know you briefly went over the enrolled agent. Most people hear about a CPA. That's where I do my taxes. So just for the average viewer out there, do you as well do a lot of the things a CPA does as far as filing taxes and tax preparing as well?
I do everything that a CPA does, except I don't do bookkeeping. That's really the difference between me and a CPA. A CPA is a certified public accountant, and I am an enrolled agent, which is strictly the tax lane. So I don't do the books, basically, is if I had to put it in simpleton's terms. That's the difference. I will give you a little bit of insight behind the curtain, so to speak. I worked for many years for a CPA, and generally the CPAs don't do the tax returns. They have someone like me doing the tax returns, because they focus more on the financials and the bookkeeping component. Now, not that there's not CPAs out there that do taxes, because there are, but that's the really simplified explanation of the difference between a CPA and an EA. I stay in the tax lane, and a CPA is in both the bookkeeping and the tax preparation side.
I appreciate that. Now, you live here in North Carolina, and I know you visit Arizona as well. So it's predominant, most of the business you do in North Carolina and Arizona, or do you help virtually elsewhere too?
I help everywhere. I help because I'm an enrolled agent, I'm allowed to do all states. And I also actually have a lot of expats. I have clients in Spain and France and Dubai and Peru, Brazil. So I do a lot of just everything. To be honest with you, I do have a large book of business in Arizona, because we did live there for a little over 15 years. But I was born and raised here in Western North Carolina. After about 30 years, decided it was time to come home. So I came home about 3 years ago, full time. And so my grandbabies and my family still are on that side of the country in Arizona and Utah, so we visit quite often on that side. But I do have clients everywhere.
The cross-border planning, international planning is a whole different topic on there, but that's great to know that you
Yes.
do that, because I see it in these different forums and groups, people always talking about who knows about cross-border tax planning or international planning, so it's good to know that's something you're familiar with too.
Yep, absolutely.
Perfect. And then now, before we continue a little further on here, my general disclaimer, as always on this channel, is this is education only. This is not direct financial, tax, or legal advice. Always be aware of your own situation, goals, and needs, and always talk to a professional about your own situation. And again, my name is David Lumberg, financial planner and tax strategist for over 10 years, a double master's certificate in financial planning, and a Marine veteran. And I also help people out virtually here as well. All right, so Linda, let's go ahead and get into our main thing on here is tax preparation and tax planning. I know in the financial world, they always talk about there's a big difference between this. People often hear this, but what does that really mean to the average person, right? When someone hears this, can you kind of break down what those two things are, what it means to you, and what people ask you?
It's amazing to me how those two collide with each other in not understanding the impacts that they are. So one of the things I always try to tell clients is, and taxpayers, is tax preparation is the moment. Okay, so tax preparation is me taking your information for the year and compiling it into a tax return. Okay, I can't do anything except compile what has already happened. Tax planning, I can help you change the outcome of what just happened for the future. So tax planning is crucial. A lot of people say, "Oh, I'm young, I don't need any tax planning." No, I'm sorry, but yeah, a little bit. Because if you don't, for example, like the fact that you had a balance due, we need a tax plan to make sure that doesn't happen the next year. Retirement, of course, is an obviously huge tax planning opportunity for our taxpayers. And the most important thing that I can always say is don't be afraid to ask. There's no dumb question. And then, of course, we're here to help. That's why you got nerds like me and you, David, is that we're the ones who like to be able to help navigate this craziness. But that's really the layman's terms of tax planning and tax preparation. It's all about the past and the future. Tax prep, I'm just taking care of what has already happened. Tax planning, I'm helping you make sure that we're on the right path.
Now, for all the years I've done this, met so many tax professionals, so many of them focus on, as you said, the current year. They might focus on 2 or 3 years out, really is all they focus on, but very few focus on the, hey, you want to retire in 10, 15, 20 years. So in your own practice on there, because you're a little different, do you also look at people to say, hey, you have 20,000. Should you put that in an IRA or a Roth IRA, or do we use long-term capital gains? Do you also advise them or talk about at least that with them over this so they understand kind of the future tax impacts for when they want to retire?
To be truthfully honest with you, which I will always do, I do that a little bit because I tend to always say I have a guy. Okay, because I'm limited on the advice I can give. So, for example, I'm not licensed for financial planning like you are. So I can't lead them too far down a path. I can give them encouragement to seek that information, and I can give them a what if scenario on their situation today if that were to be 10 years from now or 5 years from now, obviously with the best of my understanding of what that tax code would be. But that's one of the things I love about having a relationship with someone like you and other financial planners is that we can tag team and be a village, so to speak, for our clients and our taxpayers to help them know, because you're not going to know all the tax laws.
No, and I don't want to know all of them. So,
and I'm not going to know the financial stuff. So that's just one of the things that I try to do is say, I don't have the answer, but I know somebody who's going to have the answer.
No, and I love the honesty too, and that's what people don't understand is, hey, I don't want to do all the tax stuff that you do and vice versa, but it's great having a partnership for when a person or a client comes in the door, and I don't mind asking them, hey, do you already have a tax person? And if they do, I always want to make an introduction on there because you don't want to have someone like you and I that are helping the same client, but you and I never talk to each other. That way you and I can talk to each other and just kind of say, hey, here's kind of what I'm thinking, what are you thinking? That way we're all on the same page, because in the end, if we're all trying to help the same client anyways, it's best to have us all collaborate, as you said. Otherwise, you'd have the finance person doing their own thing over here, you're doing your own thing, but who knows, maybe I'm missing something that you know, and vice versa too.
Oh, for sure, 1000%. And I think it's, to me, and I know it's naive for me to say, but to me, it's just common sense to think that you should think that your financial person and your tax advisor should have some kind of communication, whether that be if they're doing a conversion or a withdrawal or getting ready to retire, because there's so many other factors that they just don't know. You shouldn't. You can't know everything. But sometimes, and I've seen this in my career, I think sometimes egos get in the way too. Professional egos are, but that's not good, obviously, for anybody. But I've built, I think, a great business with those relationships in the regards that I think I have good partnerships with other financial advisors who my clients feel comfortable with saying, hey, Linda, talk to so-and-so, or I don't understand, but you two hash it out. So, and that makes me feel so honored that they trust me enough to talk one-on-one with their financial person rather than to them back to the old round robin, start the conversation and it's not the same conversation at the end of the line.
No, yeah, and I think the last point on this is here before we move on to the other categories is people don't realize, but whether it's someone like you and me or whoever it is out there, but if we're both independent fiduciaries on there, I'm going to tell the client one thing, and if you don't agree with me, you're going to tell the client why as well, so that way the client's never worried about, oh, these two are just teaming up against me to do what's best. It's like, no, like Linda runs her own show, David has his own show, they have their own duties, and in the end, if they both don't agree, we tell the client why, but that way the client doesn't ever feel like, oh, it's David and Linda versus me. It's really a different independent approach too.
No, absolutely, absolutely, because it's weird how, and after all these years, my clients are my family, my long-term clients have become my family in the regards to how I approach them. If their outcome isn't what I think they wanted, I feel bad about that. So I would absolutely agree with that statement of never wanting to feel like we're ganging up on the client for any other purpose ever than for their best benefit. Absolutely. It doesn't give us anything to.
No, yeah, not at all. And there's some times throughout my life I've seen things where tax people have done, and I'm kind of like, I don't mind telling the client, hey, your tax person did this. I'm not sure why. I can talk to them or you can ask them. Just I'm sure in your life, if you've seen a financial advisor or planner do something that you might not understand, it's either, hey, let me talk to them or ask your person why they did this.
Exactly. And a lot of times too, lost in interpretation. What I might read and interpret a reason might be totally different than what your mindset as the financial planner was with them at the time of the conversations. It's all about communication, just understanding, because I see things on a tax return totally different than you, only in the regard to my job is to make them pay the least amount of tax possible. And your job is to make them the most amount of money possible.
Right. It's a win-win if we all collaborate too.
Exactly.
Let's go on to a hot topic here, which is always the Roth IRA conversions.
Yes.
That's a very hot topic out there too. If you want to either I can explain what a Roth IRA conversion is myself, or if you want to explain that and we can talk about that more, which is better for you?
Why don't you explain your version, and then I'll tweak your version.
Sounds great on there. So for people that don't know out there, a Roth IRA conversion is when you take that tax-deferred money, like in a 401k, an IRA, or a TSP, and you want to convert any dollar amount into a Roth IRA. Now, when you convert that dollar amount in that calendar year, that amount of money is taxable as income. So if you converted $20,000 in 2026, then come tax time, that's $20,000 of added income you have to report on that conversion. Once that money's in that Roth IRA, it's been taxed, now it can grow tax-free, assuming you meet the 5-year rule and you're over age 59 and a half. Any kind of earnings on that can be taken out tax-free in the future. Also, your contribution amount that was already taxed, that can be taken out tax-free. It was already taxed on there as well. And typically people like these because when they retire, their Social Security benefits can be taxed less. It allows lower taxes in the future. And no one knows future tax rates, of course, but it's kind of a protection or a hedge against rising tax rates. And it's also kind of tax diversification as well. But as we always tell everyone on there, you could be 40 or 50. Maybe they're good or bad. Maybe in your 60s, maybe they're good or bad. So we always have everyone analyze your own situation because there is no perfect answer.
Nailed it.
Now, do people come to you asking about Roth IRA conversions, or do you talk to people about it? How does that kind of look in your 28 years of doing this?
Well, to be absolutely honest, again, of course, is conversions have really become like a mainstream conversation, I would say probably here in the last maybe 5 years, but really within the last 3 have really heated up in that conversation. Before, I think Roths were just like the sleeper retirement account. Nobody really understood it completely. I know when I would teach and even having conversations with taxpayers, I always would do the cartoon of a house with a front door and a back door, and use that as a visual of how the tax consequences happens. But I think and I'm in this community, my age community is obviously getting older. We're getting to that 10-year, 12-year mark for thinking about retirement, hopefully, knock on wood. And conversions are really starting to become a hot topic. I think a lot of times, though, there's still some myths about the conversions and what will happen. Because I think a lot of people in their mind, I already contributed that money. It's said and done, but they don't understand that the whole converting it to a non-taxable event means you're taking money that was never taxed. Now you got to add that into the pot to take it back out to put it into a non-tax. So that's a little bit of the confusion, I think, with most of the people that I talk to. That conversation comes to me generally when they've usually had a conversation with someone like yourself. And they're then saying, how is this now going to affect me on my tax return? Because my financial guy says now this is going to be income. I always say, absolutely, it is going to be taxable income. But the good news is it won't be ever again because it's taxed. However, we obviously have to understand the consequences on what amount you're getting ready to convert. Because I think some people want to be like, all in and go for it, and then they don't realize, oh, wait a minute, that's $100,000 conversion. That's a big whammy. So
Yeah, I mean, I'm all about personally for years, I'm about don't guess, right? There's a lot of advanced softwares out there, of course. And I always tell everyone at any age, right? And I've ran into a lot of times tax people, not you per se, where a client was told, hey, I should do 50 grand. I should do 100 grand. When I ask why, or have you seen a break-even chart? When I say break-even, meaning, hey, based on your current tax status, it might take 8 years or 10 years, or what do these tax impacts look like? Oftentimes they're like, no, my tax person just told me to do X dollars. They didn't really show me any future impacts on there. And so I always advise everyone, if they have a tax person, hey, go meet with a financial planner or advisor, or if your tax person has the software, see what actually Roth IRA conversions look like to see if they make sense or not for you as well. That way, no one's just guessing. But again, we don't know future tax rates. All we can do is say, hey, based on current tax rates, here's how it looks. Another big thing maybe you can touch on is a lot of married people, especially, as you and I both know, when you're married, you get a better tax break because you have a higher standard deduction, and B, you can have more income, say in a 24% tax bracket, as opposed to if you're single, it's less income. Can you touch on the advantages of being married in a Roth conversion?
Yeah, especially people who maybe in like an older relationship, or I see because people the next chapter of their lives, they're getting to a relationship older in life, and then they decide to get married. I've seen a lot of conversions then because they are actually taking the advantage of that. A couple factors: the standard deduction doubles. Basically, it's over depending on your age, but it's $35,000. I think going to be this year $37,000, and then on top of that, people that don't understand the tax consequences, the tax table is totally more favorable under the married filing joint status. So even if you were to convert, let's just say $25,000, that $25,000 is going to be taxed way less at married filing joint than it would be at the single rate. So I have had clients who are newlyweds who would say, okay, we're going to take advantage of this conversion because my financial guy has talked to us about it. And yeah, that's amazing. Younger people, I think I have been seeing a lot of people just doing the Roth, shooting out the door in their 20s and early 30s, which is not a bad thing. But at the same time, I think sometimes they're missing maybe some tax advantages because they are young, and maybe split the apple a little more than, but again, tax planning and having those conversations, it's frustrating when I see so many people, especially nowadays, the younger generation just don't understand how valuable communicating with somebody who knows and been in the trenches rather than, no offense to anybody, but you can't get all your advice from TikTok. TikTok's a great reference, but it shouldn't be the end of your understanding of a situation, especially with conversions and the tax code and what might be good for you, especially for your big picture down the road.
No, yeah, and two things on that. We'll get to the TikTok and AI thing in a minute too. But another thing I always tell everyone too is, hey, eventually we all end up or we're in the highest tax bracket, whether it's you're single, you get divorced, or someone dies, we're all going to be there. Mm-hmm. And we're always very proactive. We try to be, and I'm sure you've seen this too, is where a widow dies, right? So the husband or wife dies early, or maybe there's a divorce that happens. And people had all that money in that 401k or that IRA, that tax deferred money, and they thought, hey, I could spend 10 grand a month. Then they're in that lower bracket, and all of a sudden it's now, oh, you mean I get taxed more? And they lose half the standard deduction as well. So also for these married individuals, it's not a fear thing. It's just a matter of fact of, hey, one of these days, one of you two is going to die first. That's just a fact. Mm-hmm. So if we could be more proactive in your tax planning and make you more awareness at least with it and saying, hey, maybe we do some Roth IRA conversions. That way, when one of you passes away, there's more tax protection for that surviving spouse. Or we say widow tax is the term in the financial world. But that's another component. How do you handle kind of the divorce / widow / someone might pass away one day in your practice?
Unfortunately, those really are conversations that are had, I think, in the moment, whether something has happened, unfortunately, tax preparation versus tax planning. Unless a spouse is ill or maybe a friend, it's happened to a friend, and now that aha light bulb moment has happened. I wouldn't say that's a common, that situation conversation as much as just what would conversions be overall. One of the things I do is I have what in my software that I use, I have a split, they call it a split screen. So I can show them the scenario of what it would look like if they weren't married.
Gotcha, okay.
So that they could see this would be a situation that, heaven forbid, if you only were taxed on your income and you were only taxed on your income. And then I can play with the number and move the numbers around a little bit. And of course, it's never the conversation anybody wants to have with a person who's passed away, or again, if they're ill, it might be a conversation that's coming up. But I think even then, it's that conversation that needs to be had but doesn't want to be had.
Exactly. Now, later on, just so everyone knows, we're going to get into the inheritance and the legacy side. Mm-hmm. We'll go over things like inherited Roth IRA, inherited IRA, stuff on basis. We'll do that towards the end. But the next thing that you touched on is the AI world, right? Everyone says, hey, who needs a financial planner or a tax person if I can go to ChatGPT, or I can go to Claude, or I can go to TikTok, and I can type it all in? And I know from the financial planning community I'm part of on there, there's a lot of great information out there. Absolutely. I use AI myself, lots of great information. However, it does not do a good job, in my opinion, of tailoring it towards someone's own specific situation. You can get all the info out there, but if you have all these pieces that are correct, but there's no AI system that I know of yet that puts it all together, I think a lot of people are over relying on AI to give them a perfect answer for their own selves, which is why I still think people like you and I are very well needed, because we piece it all together. What's kind of your thoughts on AI and TikTok and why they still need people like us?
Yes. AI, I think, is a phenomenal tool when it's used appropriately, and that definition is yet to be determined appropriate. In the medical world, I think it's absolutely mind-blowing what AI can be. When it comes to your personal situation, that is the key word. It's your personal situation. And that's not going to be the same as your neighbors, as your brother, as your sister, as your mom, your dad, your cousin, your uncle. We're all different, and we all have different situations. And that comes down to the tax return as well. One of the things that is my pet peeve in this industry is when somebody will come in and will do their tax return, and we go over the results, and the first thing they say to me is, "It's not what mine got." But why would you think that your tax return would be the same as your neighbor's? They're not. Never will be. It's like the snowflake. We're all there are no two snowflakes. There's no two tax returns. Now, are the rules the same applied to everybody? Maybe. There's a cool word in the tax code called depends. It depends on your situation, because the tax code, the tax situation could be totally different from you versus someone else's. So I believe, obviously, that I bring value because, number one, I'm going to talk to you. I'm going to try to get to know you. I'm going to try to get to know your situation. What are your hopes and plans for the future down the road? Maybe you're just starting out in a new job and you've never filled out a W-4 before. And now because I've done your tax return, I can look at your tax return and say, okay, we need to make some changes on your W-4. We need to talk about that. We need to talk about, when I look at your W-2, I can see that you're not participating in a retirement plan at work. Maybe you could defer some money. Plus, that's a great way. You're letting your employer keep some money. Take the match. And I can't tell you how many times people have said to me, nobody has explained this to me. Nobody told me what that meant. Nobody told me what an HSA account was. So AI, TikTok, Google search, all of those have their place, but I think there needs to be caution, because it's like I always say too, for myself, I know a lot of things and I depend on Google. I Google.
Oh yeah, 100%.
I Google to get me somewhere, not to give me the answer.
Yep.
So Google is a means of, oh, okay, now I know where to go look to hopefully find the real answer. It's the GPS for research, really. One of the other things too is just, I think we've become such a instantaneous society. Somebody's got the answer, Google's got the answer, it's done. And then we don't like the outcome. And then it's kind of, okay, I didn't like the outcome. I didn't like what happened there. So how do I change it? But then when you tell them how they got to change it, they don't want to do that either. So it's a battle. But I think AI is obviously, it's not going away. It's going to be here. I think we've got to learn to embrace it. But at the same time, it can't be a replacement, I'm going to be selfishly saying, for us, because I think that personal approach, that personal connection, there's so many layers there that AI, at least I hope AI never can be what Linda Reader, her favorite ice cream, and then what's her topping. I don't want AI to know that.
Right, there's that human element, right, and the emotional element when it comes to retirement planning, or can I retire at 60 or retire at 65, or do I want to pay these taxes, like you said. And oftentimes comes down to feelings that we have with a lot of clients is, hey, you can retire at 60, you might have a little less money, but you have more years of life when you're healthy and active with the person you love. You can wait till 65, and sure, you get Medicare that kicks in, but that's 5 more years of life that went away on there as well. So it's a matter of how would you feel having less money to spend but retiring earlier, or more money to spend, you work longer. And like you said, AI doesn't understand that human emotion, that human element. in their tax planning too, if it says, hey, you know what, we can make you more money, we can save you more money, but at what cost to your own health, your own well-being, to the person you love as well. And that's where we as human beings have to come in to say, it's a feeling, it's a personal choice that no AI, no computer system can make. And that's where we have to have those conversations so we can put it out there and saying, hey, how does it make you feel? What are your own beliefs? Because that can't be in a computer.
Right, absolutely. Quality over quantity, for sure. Yeah. Whether that be quality of life, quality of your retirement. And it's just, yeah, there's just so many layers and so many, I think, just different components to the calculation that the human touch, I don't think can ever be replaced. At least, God, I hope not. I hope not. So no computer or no robot hopefully will ever be able to take the human touch away. So
we're going to go over the next kind of big retirement tax surprises, the big investing taxes out there. I'll throw some terms and definitions, and you can give your take on it or talk about whatever else too. But really, there's three big ones everyone kind of knows of, and some smaller ones. But the three big ones are the tax defer, that 401k, the IRA. You put the money in, you get a small tax deduction. The money's not taxed until you take it out in the future. Then we have that Roth IRA or Roth 401k account where the money's taxed on the way in. If you take it out in the future when it's qualified, it's tax-free. Then we have the brokerage account or that non-qualified account that's not talked about so much, but in short, you get the short-term capital gains. You held it for 1 year or less, you sell it, it's taxed as regular income. But what we try to focus on the planning side is that long-term capital gains. You've held that stock or ETF or mutual fund more than a year, you get that more favorable long-term capital gains tax for planning purposes. And then earlier you mentioned briefly the health savings account or the HSA. It has that triple tax advantage. Yes, it's a high deductible health plan, so we had to review it, but people don't realize that you can utilize that money in retirement as well. And then we also look at kind of the ghost tax, we call it, that Social Security benefit tax. Now, it could be a small amount, and I know current laws, they're always trying to change it, but people are not aware that Social Security benefits can be taxable as well. And then, of course, the last one really is more pensions, which my age group is not going to be as common, but maybe for your age group it is more. People are just unaware on how that when their pension is taxed, they forget now their 401k is taxed more, and this is taxed more too. But that's just some big things that I've seen from my planning side. What are your thoughts on those or other things you've seen in your own experience?
Yeah, so those are all of those. You might have to recap because you went through a
Hey, you're good.
Yeah. But 401k, obviously that's probably the most known, the most familiar terminology, 401k. Deferred, meaning, like you said, it's going to defer from your income as earned that year. And then once you retire or distribute it, that's when it gets a tax hit. A lot of those, again, tax planning, there's a couple layers. Obviously, you got to know what your 401k availability options are with your employer. I always tell my clients, I don't know what obviously funds that you can invest inside your plan is, but to try to always at least step up or start off with the mat that they match.
That one. I'm all about the match if you can get it. So
yes, because that's free money. You're telling the employer, nah, I don't want that. Nah, you keep that. Because they're not going to contribute to it usually unless you contribute. There's some retirements out there, some employers that do have a vested plan that after 5 years you get some vested monies contributing. I think some of the hospitals, I know here locally, some of the hospitals have plans like that. But the amounts are minimal, 1 or 2% maybe, but still, that's some money. But always for what they contribute. If their max is 5%, then either start with 5% or work yourself up to 5%. And then, of course, obviously contributing Roths. A lot of employers now have the Roth opportunity through the 401k. Again, what is your income limitations versus income needs to be able to take a tax deferment? Because the Roth isn't giving you the tax deferment. But those earnings are being earned, hopefully tax-free, if you don't mess with it. So those, and then of course retirement pensions those are very rare nowadays. And pensions, I think a lot of people don't realize pensions are ones that are established through the employer and automatic. Like the post office, for example, OPM is the Office of Personnel Management, is the retirement for the post office. The post office, the railroad, those are probably the one industries that still have a retirement. Most other
like teachers, federal workers, military, some cops and firefighters, right? Those are kind of the main ones.
Yeah, municipalities, those, I mean, but Intel, for example, they're in Chandler, Arizona. They don't have a retirement. They have a 401k. They have a profit sharing. They have those kind of things. But it's all about, when I look at somebody's W-2, your W-2 will tell me a lot about your situation with your employer. The HSA, for example, there's a code on the W-2 that's a W, which you would think that doesn't make sense. HSA, and they give me a code W. But the code is a W, and if you have a W on your W-2, you've contributed or your employer has contributed. Because an HSA, sometimes you don't even have to contribute yourself, and your employer will put some money in. And then they have this money in this account that they didn't even know they had. And I say to my clients, well, you had an HSA. Did you use any of that money throughout the year? What's an HSA? A health savings account. I don't have that. Your W-2 says you do, and you had $500 put into it. Did you get a debit card in the mail that looked like a Visa that you were like, what the heck is that? And you might have thrown it away or shredded it. I hear that a lot. But again, this all comes down to just conversation, having someone that they can feel comfortable with to ask. I always tell my clients, I'm here all year long. I don't go away. I might go away on vacation, but my phone is always hooked to me. My laptop is always with me. You can always ask me a question. Because if you don't know, who's going to tell you? And if you don't ask, how are we going to help you? But there's just so many layers of opportunities that I don't understand how people don't know the benefits.
There's so much out there, right? There's so much out there. Now, I guess question for you in your tax planning when it comes to a brokerage account. That's what people just call it as brokerage. It's that non-qualified account. We do a lot of tax preparation and a lot of education on long-term capital gains. Do you touch a lot on long-term capital gains, like what that is and how that might help someone in your practice?
I do, especially if they've come in with a brokerage statement, a 1099-B in my business, a consolidated statement. Sometimes they'll be called consolidated statements. The younger people, I think those are starting to become a little more popular with the brokerage. I think crypto has obviously opened that door. But the brokerage accounts, oh my gosh, we could talk for hours about brokerage accounts. Capital gains is the magical tax, okay? So if I could geek out on you on capital gain tax for a minute. So people say, how does Warren Buffett not pay tax on $5 billion? He only pays $700,000. I'm being facetious.
No, yeah, absolutely.
Capital gains, that's how. Because it's a whole nother tax bracket. Okay? So you've got your ordinary tax bracket, which is on your ordinary income, which is your wages. Like you said, if you had a stock that you held for less than a year, that's going to be ordinary. Interest that you've earned, dividends, as long as they're not qualified dividends, those are all what's called ordinary. So that's going to fall under or what's called your marginal tax, which is either 10%, 12%, 22%, 24%. Capital gains is 0 to 15, the end. Okay? So if you had it for more than a year and you sold some stock, that capital gain treatment's going to come into play, and it affects the whole return, not just that tiny bit of money. And the other thing, and I'm sure you've talked to your clients about it, is harvesting. Where you might harvest some stocks from the brokerage account to help with capital gain.
Some gains and losses net out there on that side. And kind of like you were saying too, on the long-term gain side, just for viewers out there, as Linda was saying, there's a 0%, and then there's a certain income to 15, and then from 15 to 20%, but 20% is the highest number. But I will say, if you're married, that 15 to 20% bracket, I'm just guessing, has $300,000-$400,000 of income.
It's huge.
But still, if you're a high-income earner, 20% is the most on long-term capital gains. That beats 34, 36% out there too.
Yep. And it's a huge savings, and it's an eye-opener savings, because I always, especially when a client has had a capital gain event, I always show them that worksheet. There's a worksheet for everything. I'll show them that worksheet so that they can visualize that tax change from what their ordinary rate would have been had they not had those capital gains versus what now their tax is because they had those capital gains. And it's usually, whoa, what? Really? So it's usually a big aha moment. But again, it all comes down to, don't be scared. Don't be afraid to think about those opportunities that if you don't know and you don't ask, you're going to be left behind.
Right. Yeah, in real estate, that's another whole curveball as well. But on the real estate side, your primary residence, there's capital gains there. Because, of course, a lot of people, when they hit their 60s, a lot of them are selling a home and they're downsizing. They typically have a gain. That's a whole other thing. And there's real estate properties too. But I think the big thing, as you touched on, is, hey, there's so much out there from tax diversification. And what I see so often is people that are in their 40s and 50s, they have way more time to do a lot of this planning. Whereas when someone's 65 and they have $3 million in a 401k or IRA, there's not much we can do because time's really not on your side. Yeah. So I do love the proactive nature and the educational nature there as well too.
Yep. And just to add on that, the capital gains, if you do have some capital gains situation, that could be a great time to do maybe a Roth conversion, because it does change your tax overall a little, not obviously dollar for dollar, but it is a substantial tax planning that if you know you're going to have a big hit with some losses, maybe a conversion could help with that, because not losses, capital gains, because it is going to affect your tax margin. So.
Perfect. Now let's go on to our next topic on here, which is the legacy and inheritance side. And for those that are just tuning in halfway through here, again, we have Linda Reeder. She is over 28 years as a tax professional and enrolled agent. I'm David Lumberg, financial planner and tax strategist. Now, on the legacy and inheritance side, I'll do a brief recap, and then you can by all means expand. But the big three people don't know is the inherited IRA. So whether your spouse gets that or your kids get that, an inherited IRA, it still means they have to pay taxes on that money too. So if I got $1 million from my dad in an inherited IRA, I typically get 10 years to take that money out, but when I take it out, I'm taxed on it. Or an inherited Roth IRA, even if my spouse dies, I receive that money. An inherited Roth IRA on the qualified withdrawals, that is tax-free when I take the money out as a surviving spouse. And then we have that brokerage account. When someone passes away, they receive that. They get a step up in basis. There's no tax on that. So maybe my wife passed away with $1 million. She had a $500,000 gain, $1.5 million. I get the full 1.5 tax-free, but I don't have to worry about a 10-year time period involved. So those are the big three. Linda, what are your kind of thoughts on inheritance and legacy and accounts like that?
Yeah, well, obviously those are blessings that your loved one has left for you. So with that, obviously, to what you said with the 10-year rule, that's new. That came down with the Secure 2.0 Act. Everything else have a funny little name. But so that one has taken some people by surprise because they're not fully aware of that change, because that is a dramatic change from the past. But that 10-year rule applies to anyone who's not a spouse. However, RMDs in there, if there are RMDs, the RMDs also have to be taken if the person who passed away was taking RMDs at the time. And
just for the viewer out there, that's your minimum distribution. Correct. Or RMD. I know her and I know lots of acronyms, but
yes, sorry, acronyms get in the way. Yes,
that's why we're here for each other.
Yep.
Linda, could you do like a quick little 30 seconds on what an RMD is?
Yeah. So required minimum distribution is a set amount of money that you have to take out of the account. Now, again, with the Secure Act changes, they changed the year, or not the year, your age. It used to be 70 and a half. And those people who are at 70 half and had started taking theirs are already set. Now it's gone to, oh, correct me if I'm wrong, David, 73.
Yep, 73.
Yeah. Depending on, I think, what, 20, oh my God.
Yeah, when you were born,
2024,
yeah.
right.
It's typically 73 for everyone new coming into it.
Yeah,
So.
but everybody's RMD is going to be different because it's based on how much money is in your account, and then it's divided by what they believe your life expectancy is based on the year you start taking it, or reach that age. So my RMD may not be the same as David's or Joe Smith's or John Smith's, but because of our age, we may have our RMD that's required. Mm-hmm. If I had an RMD because I had reached that age and I passed away, my beneficiary has to take that RMD. And then they then have the 10 years to then take the money. If it's a spouse, if they're a spouse and they inherit it, the rules are different than if I left it to a child or a niece or a nephew or a grandchild. So you just have to know that there are definitely differences. And again, what a financial planner or a tax person can help you. There are tools as a tax planner that I can help you kind of understand what an estimated RMD might be for your future. But again, without knowing what your complete portfolio was, that would just obviously be an estimate. Your financial person is usually your best person to obviously disclose that for you.
And we talked about Roth IRA conversions earlier in this conversation, but coming back to now, there are some times where I might tell someone married that says, hey, it will make no sense while you're alive to do a conversion, but if you're trying to keep that surviving spouse or your kid or your kids to have a greater tax impact, then maybe doing a Roth IRA conversion won't impact you while you're alive, but you are protecting that spouse or those kids in the future too, is something else we look at as well.
Yep, absolutely, because RMDs don't apply to Roths. So that's obviously, other than it not being taxable, that's another huge benefit to a conversion, just because you're taking away that almost that forced distribution rule. And on top of you being required to take out a minimum distribution, if you don't take out a required distribution, they will penalize you for not taking your money. So there's that layer on top of that. And I have a lot of, in the past, I've helped a lot of clients who've had to unravel that potential costly penalty because of just not understanding that RMD ramifications.
Yeah, so a big thing, if you have inheritance or legacy, you're trying to be proactive and not reactive, ask your tax professional or ask your financial planner or ask them both, because obviously once someone passes away, it is what it is. You can't do anything on there either.
Absolutely. Yep.
On our next one here, on the state side here, we can touch briefly on there, but you and I are in North Carolina and in Arizona, we both live at, we work everywhere else too but whether it's a flat state tax or it's a system tax, another big thing is not long-term capital gains. I know Arizona taxes that differently than North Carolina does, but what are your quick thoughts on North Carolina, Arizona, or just states in general?
Great question. So specifically North Carolina and Arizona differences. North Carolina has a flat tax, like David said, 4.25%. And the good news is North Carolina does not tax Social Security, so that comes back out. If you are a state retirement beneficiary that falls under the Bailey Act, your retirement may not be taxable, but that's the Bailey Act, so there's a cutoff there. But it's easy to plan at 4.25% what your potential tax consequence could be. Arizona is a little wonky in the regards to it has a tiered tax, so it's as low as, let's just say they just changed it in 24, and I haven't got those memorized yet, but it's 1% up to 5% or 0.8% up to 5%. So, and again, Arizona doesn't tax Social Security. Arizona has very favorable tax treatment. They don't tax Social Security. They don't tax military pay or retirement. And they do not tax, if you're a state employee, they don't tax the first $2,500 of retirement. So there's a lot of benefits at the Arizona level, not only in the regards to what income is taxable to begin with, but in the fact, of course, what your level of tax is. And those tiers are based on the income. Obviously, it thresholds out 30,000, 50,000, 100,000, blah, blah, blah. But again, much favorable tax treatment. Most clients, most taxpayers, I'll say, usually fall in that 2.5, 2.7 range with the Arizona tax table. You have to be making, I think, over 400,000 to start get up into that 5% range. But 5% is still, compared to other states, it's a very favorable tax. Because if you look at California, for example, their state tax rate is knocking on 10%.
Yeah. That's why so many people retire in Arizona, or they retire in Florida, or North Carolina is becoming a popular state too now, I've noticed, for a lot of retirees.
It is.
But, you got to be aware of that.
Yeah, even with the 4%, it's still a lot less favorable, or sorry, it is a lot more favorable than Pennsylvania. We got a lot of people coming down from Pennsylvania, a lot of people from, oh my gosh, New York. Love our New Yorkers, but please, I'm blessed you're bringing your pizza. No, I'm kidding. I'm kidding. I'm kidding. He can cut that out. But those states that have those high taxes, yeah, it may be 8%, let's say, and then you come down to 4%. That's a huge savings. I will say, though, there are some states that do have really good retirement benefit. For example, New York again. New York doesn't tax the first $20,000 of your retirement once you reach 59 and a half. That's a big chunk of money not to be taxed. Whereas you come to North Carolina, you might have had that deduction up in New York, but you come to North Carolina, you're not going to get that deduction. There is some things that are great. Every state has those in the tax code, but you just have to be aware of them, be ready to pivot and prepare for those. And you generally, sometimes it's a wash. It's a lot.
No, yeah, I think what she's trying to say for one out there is, hey, you have to be aware of your state. That's when you talk to a tax person. It's federal, but on top of your state as well, which is why states matter. Now, Linda, I know you and I could talk about taxes forever here, but I want to be respectful of your time here too.
Yes.
So I guess if I could ask you, what are some some big last misconceptions, or B, what are some big things you'd want people to know as well regarding tax planning and tax prep, and regarding just retirement as a whole?
Yeah, I love this conversation. I don't know if that's been evident in my answers, but this is one of my favorite conversations. I would say, if quickly could take away anything in a nutshell, is tax planning, especially when you're getting ready to retire, is a pivotal part of the plan. You fill out your retirement paperwork, you fill out your potential Social Security, Medicare paperwork, but in time that you're doing all of those things, you having a conversation with your financial person or your tax planner, preparer, for a tax plan is very important, because there's so many trickle down effects that you might not know. Because even though you've been told, oh, your Social Security is not going to be taxable, not true. Up to 85% of it could become taxable income depending on your other income sources. So again, a quick conversation with your tax person should be able to help you understand that hit, because I can tell you that's probably the biggest aha, is when they had no taxes taken out of their Social Security, or they didn't plan for that to be taxable because they assumed it wasn't taxable, and then that number moves over into the taxable column. And
I think that word assumed is a good word you touched on here briefly, because so many people, tax-wise and retirement-wise, they assume things, they guess things, they don't ever ask the questions, they never have that free consult to ever have one even. And there's so many people that I've helped retire earlier, or save more money, or do better tax planning. So I think it's what you believe in too, is, hey, don't make assumptions, don't guess. Call Linda, or call your tax person, right? Or call your financial planner, or someone like myself, and ask those questions. Now, Linda, if someone wanted to get in touch with you, how do they contact you, and do you offer a free consult as well?
I do offer a free consultation. You can reach me, obviously, at my phone number is 480-278-9334. That is an Arizona number, so my North Carolina people, that's fine. Don't worry about that. And you can also get me at linda@taxres1040.com. That's my email, and my website is taxres1040.com.
Perfect. We'll have all that in the links here below as well. Now, Linda, do you offer like a free initial consult, whether it's 20 or 30 minutes by phone for people's questions? Or?
I do. Yep. I generally about 30 minutes, whatever we can answer quickly in 30 minutes. Not hard pressed of 30 minutes. I like to talk. So, but yes, there would be no charge for questions. I'm not going to do your tax return for you now, but questions, I love to educate. I love to help people understand any of their misconceptions and make sure that they're on the right path.
No, definitely. And I think that's with my own self too is I have my email down here below and I have my phone number too on there, but don't make assumptions, don't guess, make those phone calls, have that free initial consult if it applies to you. Because today, Linda and I just touched on kind of the bigger concepts, right? There's a lot more complex strategies. There's a lot more business owners, entrepreneurs, people that are making $1 million a year, stock options, equity comp. These are all bigger things that we go into complexities, but we wanted to touch base on the big things on here. Linda, anything else you wanted to say before I close this out here?
Nope, just obviously don't be afraid to ask. It's okay not to know. It's okay, really. It's not okay not to ask. Don't not ask. And then just do your research and enjoy your retirement. You worked hard for it. So if you're ready to do that, I'm jealous, then go for it.
Absolutely. Linda, I really thank you for being here today, going over all these tax questions. If you've been watching this out there and you have comments, you can always comment below. You can reach out to Linda and or myself. You can call us here too. But if you like this, we could have future tax concepts. Maybe we're just on one topic only. We go into the weeds just on one topic too. Linda, thank you so much for being with us here today.
Yes, absolutely. Always here for you. Thanks, y'all.
All right, thank you, Linda.
Bye.